Bitcoin didn't rise because of rates, at least not this time. Something else moved the market. Let's look at three key dates: April 29th, April 30th, and May 2nd. On April 29th, the Federal Reserve held rates steady. But the important part was not the decision itself. The important part was uncertainty. Internal views were divided. There was no clear forward guidance. So Bitcoin did not break out, but it also did not sell off. It simply held its level. Then came April 30th. There was no clear forward guidance. So Bitcoin did not break out, but it also did not sell off. It simply held its level. Then came April 30th. Oil prices moved higher. Geopolitical risk increased. That matters because higher oil can increase inflation pressure, and higher inflation can reduce the chance of near-term rate cuts. Under normal conditions, this should pressure Bitcoin lower. But Bitcoin did not fall. That was the first signal. Selling pressure was limited. Then came May 2nd. This is where the structure changed. Bitcoin ETF inflows increased sharply. On May 1st alone, more than $600 million flowed into Bitcoin ETFs. BlackRock's ETF alone accounted for nearly $284 million. This is not sentiment. This is institutional capital. Over the past week, more than $800 million entered the market, and in April alone, Bitcoin ETFs saw more than $2 billion in inflows. Now, look back at the chart. Bitcoin did not spike randomly. It moved higher gradually. That is important. This looks more like accumulation than speculation. So the sequence is clear. April 29th brought uncertainty. April 30 added negative macro pressure. But Bitcoin still did not break down. Then ETF capital flowed in, and price responded. The conclusion is simple. This move was not driven by expectations. It was driven by liquidity. Right now, Bitcoin reacts more to money than to news. Not expectations, real capital.